All right. So you are at the rise of embedded secured lending. You'll learn all sorts of different things about how we're partnering with organizations serving credit unions. Specifically today, we have LoanStar and GreenLyne. Really excited to share some of the things that they've been working on together and separately. And so wanted to just start off, make sure, I see a lot of familiar names out there, but want to make sure that everyone has a good understanding of who CUCollaborate is. My name is Ben Herring. I'm the Director of Partnerships for CUCollaborate. We are a data and analytics CUSO. We became a CUSO last year, and several credit unions across the country have decided to get involved in CUCollaborate by being investment partners. We're really focused on helping credit unions grow. And we do that through several different ways. And it's kind of two main lines of business. We build and operate software, and we have a full consulting team that kind of like leverages the efficiency of our software to drive strategic insights and deliverables to credit unions across the country. We're serving about 300 credit unions and can serve credit unions of all different sizes. And so would love to, if we don't currently work with you, do that, but also know that we've worked with many on the line here and wanted to share with you a little bit more about how we're partnering with companies that are driving value to our clients. And so a little bit more about our areas of expertise, and this actually helps us to set the stage for what we're here to learn about today. We have three main areas of expertise, like I mentioned earlier: growth, performance, and impact. And we have a lot of different lines of business that fall within each of those sections. And so our bread and butter has been to date kind of like field of membership expansions, charter conversions, helping credit unions with their growth strategies when it pertains to SEG relationships and community outreach. We've been backing into helping credit unions with their marketing and branding efforts, finding their next merger partner. Focused really a lot of our energy around building out our software to help credit unions with performance analytics, branching strategies, product development, et cetera. And then finally, helping credit unions gain access to some of the beneficial regulatory programs that are out there, specifically the CDFI certification and the low income designation. And that helps me set the stage for why we're here with LoanStar and GreenLyne. And so when we look at companies in our environment that are working with credit unions, the way that CUCollaborate positions ourselves in partnerships is with organizations that are helping our clients take the next step that we're helping them to envision or to create. And so a lot of our work is strategic in nature, but we are not a lender. We are not we're not building out marketing tools that are specifically targeting members in communities like GreenLyne does. And so when we're asking a credit union or helping a credit union through their CDFI certification or helping them reach more members in low-income designated areas, we can craft a strategy, but we need folks to help get those members into your credit union. And so that's why we're here today with LoanStar and GreenLyne. I'm very fortunate and honored to be here with Geoff Foytack and Sid Mansur at GreenLyne, and we'll be hearing plenty from them today. So I'm going to go ahead and take my screen down, and we'd love to hand it off to our friends over at LoanStar, specifically Geoff, if you could pop on.
Yeah, thank you very much, Ben. Thank you everyone for joining today. And as Ben had mentioned, there's a lot of different things that CUCollaborate does, and the way we partner with CUCollaborate is we had a lot of our clients say, hey, we want to penetrate more into the LID or CDFI space. And we certainly leverage CUCollaborate in order to do that. And we're really excited, the three of us, to be talking about the rise of embedded secured lending and what that means. So, I thought it would make sense just out of the gates to walk us through what do we mean by secure embedded lending. And I put this visual together. Hopefully it makes sense and gets everyone on the same page very early. But if you think about embedded finance, really what we're doing is there's step one here. There's a business that needs to match with a banking solution to offer their clients financing. So today we're going to be talking about how can we help people that have a need in the home improvement space to tap equity through a HELOC and do more HELOCs. And that way there's many different ways that that helps not only your organization, but also the community. And Sid's going to walk us through that a little bit later. But in order to do this, you're going to need a portal, a solution in the middle that can take that applicant data and then send that off through the API channel into your consumer LOS for decisioning, and then bring that decision back to both the merchant or contractor and applicant. Where LoanStar fits into this mix is we have the integrations into the most common consumer LOS platforms, especially for HELOC as well, in addition to unsecured and credit card. But today our focus is going to be on HELOC and how we can help really what we call re-intermediate a lot of the people in the community back towards credit unions. And there's two additional slides I'll just touch on briefly, but embedded finance in general is a massive market. It's about a $54 billion estimated market that has growth potential that is just off the charts. And where we find that we can help is we take a look at these current market conditions, and we see who's dominating this space today. And there's some familiar names here, GreenSky, Truist, Synchrony. So the point I'm making is that these loans are happening in your backyard today. And what we want to do is let's bring them back to the local community credit unions that can be able to service them a little bit better, provide, I think, a much better user experience for the new members that come through. And the way that we help provide you with a real competitive advantage is the three of us teaming up together, right? So LoanStar's got the integration into the LOSs, which makes it easy for you. We're able to access to see, is this person qualify for an LID or CDFI zone? And then what we're going to really focus on today is GreenLyne's fantastic technology of how we can make this really unique. And the key here in the embedded finance space, especially with home improvement projects, is speed on the front end. That's what they're used to. And that's really where we come into play here by teaming up with GreenLyne, where we take a pretty complex program of a HELOC and make it very simple. And in addition to helping not only that consumer, we're able to also help you build deeper relationships with maybe existing SEGs. Maybe there's business members that you already have that would love to offer your financing at the point of sale, or you can use it as a tool to get new business members if that's something you do. But overall, there's just a lot of different ways that we can help you re-intermediate these new members, bring them in. This would be your member, you're servicing the loan, you cross-sell them. And we have so many stories of folks that that we've helped, and help expand that relationship. So wanted to just lay out sort of the market, where things are, and how the three of us combined can help you with a really distinct advantage. I think you're going to really be impressed with what Sid and team are going to show you in a little bit. Just a quick note on LoanStar, just so everyone knows, we are a CUSO. We've been doing embedded financing for going on 10 years. And we're really lined up with the credit union mission, and really thrilled to be, part of this webinar today, and happy to answer any questions with that. And part of this solution, I'd say the other leg of this stool is going to be Sid and his team over at GreenLyne that can help us on the front end of that, three-step equation that I laid out. So I'll pause there and sort of hand over to Sid and team to walk through the solution.
Awesome. Thank you so much, Geoff, and thank you, Ben, for teeing this up. First and foremost, thank you to everyone in the audience here. Very much a privilege to be here with you all today. I'm Sid Mansur. I'm joined by my colleague here at GreenLyne, Abheek Sambyal, who's really been spearheading the innovation effort for us for the last decade. Now, let me see if I could get my screen to share. Let me just get this set up really quickly. There we go. All right. Okay, so over the last 10 years, we've seen the rise of fintechs and de novo banks come to the market with really compelling technology that makes the process of obtaining a loan much more swift and easy. And the technology innovations that these fintechs have created, what we observed is that they hoarded the technology. They used it to really originate the loans themselves. And we felt that really left really significant gaps in the market in terms of consumer service and being able to adequately serve members in the community. Namely, these fintechs and de novo banks, they rely on the technology to keep the consumer at arm's length, and there really isn't much of a human touch if needed. And so, especially underserved consumers, there are times when that touch is needed. I myself have been on that need, and by using these technologies that make the process of obtaining financing faster and easier, we oftentimes encounter situations where there's no human being to really talk to on the other side. And so we set out, we being GreenLyne, in partnership with LoanStar and CUCollaborate recently, we set out to really craft this technology that fintechs have been using, but instead of hoarding it ourselves, bring this technology to CDFIs and to credit unions so that they can, in fact, bridge this gap that we see in the market. The speed and ease of digital lending combined with the support and trust and confidence of knowing that there's a human being within arm's reach that they can reach out to within the credit union or the CDFI. So, Geoff laid out a very compelling overview of what is embedded finance. What we're homing in on here is embedded secured finance. This is, think of it as, if you're familiar with embedded finance, to some extent, you will have heard about Klarna and Affirm. These are embedded financial facilities that are available for small size transactions. Buying a pair of shoes, $100 transaction, and Klarna is embedded right at that moment of transaction where credit is made available near instantly. And so we looked at that and we said that there are transactions that are life-improving transactions, life-changing transactions, home improvement transactions with contractors that will install a new kitchen or do roofing repair. These are transactions that are $20,000 and up. When it comes to the installation of accessory dwelling units, we're looking at $500,000 transactions. These transactions should be just as easy, just as swift as the embedded transactions and the embedded financing happening on small cap purchases. And so the way in which we facilitate these larger transactions and the specific kind of financing that gets embedded are home equity based financings. So your traditional HELOC, home equity line of credit. Now, with this HELOC, the whole idea is to accomplish the following. Number one, instant decisioning. So the moment a homeowner engages in a transaction with a merchant, let's say that it's a roofing contractor, and wants to close that transaction, right at that moment of truth, what we do is provide instant decisioning on the HELOC that could be used to finance that transaction. That instant decisioning is based upon, and we're going to get into this a little bit more, it's based on your underwriting guidelines. What is your credit box? That specific credit box is what we pull into our underwriting engine, and we make sure that we're doing all the automated documentation gathering. We'll gather the AVM in split-second time. We'll gather the tri-merge credit report. We'll gather homeowners association fees, title, et cetera, et cetera. The whole corpus of documents that are needed to do the underwriting and the loan decisioning, we essentially go in and gather that through all the database integrations that we have in split-second time. Push it through the underwriting engine, make a loan decision, and then if the decision is yes, push it through a pricing engine, which again is using your rate sheets and your rate card. And then after the loan has been priced, the next thing that we do, and you'll see this in the demo, is something that's not traditionally done. But we think it's a very important part of being able to adequately, safely, and responsibly serve LID and LMI homeowners. And that is to optimize the size of the loan, to make sure that the maximum credit line that is extended to this individual is a safe sized credit line. And for that, what we do is we ask the applicant for permission to hook into their bank accounts, retrieve their bank statement, and we retrieve their bank statements, look at what is their monthly cash flow, what are the inflows and the outflows, and how much can they responsibly afford to pay if taking on a new debt. And if they're going to use this new debt, this HELOC, to pay down some of their existing debts, we go through those calculations to really determine what's a safe monthly payment they can afford. And for that safe monthly payment, what would be the right loan size that would equate to. And once we determine that, and the applicant decides to accept this loan within that credit line, within that credit limit, what we do is we wrap insurance around this. It's no cost insurance that is wrapped around this loan that keeps the borrower safe and the credit union safe. In the event that the borrower encounters economic hardship, loss of job, or medical disability that could prevent them from being able to make monthly payments on the loan, we immediately step in and make the monthly payments on their behalf. And each year we will, for the given year, we will make up to 8 months of payments. And then the clock resets every year. Every calendar year, that clock resets. So that allows us to really de-risk these loans and provide incredible peace of mind to the homeowners that are seeking these loans. All of this capability, again, is wrapped up into a technology stack that can be deployed directly to merchants on behalf of your credit union, so that when the merchants are negotiating some project with a homeowner, right at that point of transaction, they can work this instant loan decisioning, loan pricing, and loan origination, loan underwriting, and loan insurance right into that transaction. And so for now, I'll skip over this slide. We're going to come back to it. But just to give you an overview, when we say merchants, we're talking about home improvement contractors, ADU builders, elective medical procedure, doctors and dentists, and IVF clinics. Essentially, the constellation of small and medium-sized businesses that are already members within your community, their businesses within your communities, where thousands of daily $20,000 and higher transactions are occurring that need financing. We're gonna, I think this is a good spot for us to jump right into the demo. I'm gonna actually stop sharing and allow my colleague Abheek to go ahead and share his screen so we could show what this embedded secured financing deployed on a mobile platform actually looks like.
Thanks, Sid. I'm sharing my screen. Is it visible for folks?
Yes. Yep.
Okay, awesome. Hello, everyone. So let me jump straight into the demo. As Sid was saying in the last slide that he paused on, this is a, this solution, this platform is meant for the merchant and the borrower to, at the point of sale, for them to have that conversation. What you see here in front of you is kind of a narrow layout of the web page or of the platform, because it has been optimized for mobile view, which is where a lot of these conversations happen on the ease of being able to access these loans through a phone, iPad, so on and so forth. So for the purpose of this demo, we're going to walk through the borrower's perspective. So a borrower is having a conversation with a merchant, let's just say an IVF clinic, and the borrower, the homeowner, she's interested in applying for a HELOC loan. So this is what her experience is going to look like. So she'd come to this site. This is the GreenLyne site for the application. We're going to put in the borrower information, or the borrower going to put their information. So let's just put that in. I'm going to collect some additional information. I'll just put in some date of birth, phone number, email address. Social security, and we'll talk about a little bit why we're collecting all of this information in a minute. Collect annual income, citizenship status, just put in employment name. All right, so we've collected a couple of information, and the final piece of information is the home address for the homeowner. This is the property or the home against which they're applying for the HELOC. All right, and as we said that the borrower is applying for a HELOC for a merchant, so they're going to select the project cost or the procedure cost, and they're going to click on this button called Generate Offer, and we're going to collect an authorization for credit, and you will see that instantaneously we're able to offer back to the homeowner an initial offer. In this case, we are telling John that he's eligible for up to $136,500 in a HELOC loan. That is the limit or the maximum HELOC loan that he can be approved for. So what is happening behind the scene? In a matter of few seconds, what we have done is, because we have collected the homeowner's name and address information in real time, like Sid mentioned earlier, we are able to pull their title information, we are able to pull the property value data, the AVM data, and because we've collected credit authorization from the borrower, we are also able to do in real time a soft credit tri-merge report. So we have pulled all of this information from third party, and instantaneously using the rate cards, the credit box, the credit criteria that you have provided, we're able to calculate what that loan offer should look like. So we've done all the calculation, and we've given the homeowner an instant decision that you can qualify for up to $136,000 in home loan. If the borrower chooses to proceed, they'll click on the next step, and then you will see that we then collect a couple of additional pieces of information to further refine the loan offer. So they go through this workflow. The next step that you see here is income verification. So in the initial stage, you saw that the homeowner provided self-reported income. They put in $125,000. But to be able to do the underwriting for this loan, what we need is verified income. So what we have introduced here is bank statement-based loan, the income verification step. So the homeowner will quickly go and connect their bank, and through that we're able to pull their bank statements, and using the bank statement information, we can do quick income and employment verification. So just very quickly going through those steps. All right, there you go. So we're able to pull their income data. We'll pull all the information from their bank statement. They click next. We pulled employment information again based on the deposits that we're seeing in their bank statement. We can do verification of employment. Moving on, because we've already taken the credit authorization from the customer, from the homeowner, we're able to, again, like I said, pull the tri-merge credit report, automatically extract all the liabilities that they have on their credit report. So all of this information is collected. We also can collect a homeowner declaration. So I'm going to skip this step, but essentially borrowers or homeowners can also connect through their insurance provider their homeowner insurance information and homeowner insurance declaration. So once we collect all of that information, you will see that the offer is revised again. So when we gave the initial offer, again, it's a two-step process. At the very beginning, we give a very quick initial offer, and then we revise that offer by performing additional verification steps and by pulling additional information. So did you want to say something? I thought I heard a nod.
No, I'm good.
Okay, all right. So in this step, again, this is one of the final steps here. As you can see, the homeowner is given a couple of options to configure the loan that they want to finally apply for. This is the merchant. This is the cost of the procedure or the project they want to do, whether it is an IPF merchant or whether it's a pool contractor, roofing contractor. You can see here that this is the minimum loan amount and this is the max loan amount that the borrower is approved for. They can specify how much they want their initial loan amount to be. And let's say they do their configuration, we recalculate all the fees and the loan amount, and then they will go ahead and go to the final screen where they see all the information, give us consent, and then the final step is hitting the request loan button. And at this point, all of this information is packaged and sent to the credit union in this case through the LOS system. So all of this information is packaged and pushed into the LOS system. One of the other things that we do
really quickly here, Abheek, I just want to interject. This is where it's very critical for us to have this integration with CUCollaborate and with LoanStar, because the way that this loan at this point, an actual Form 1003 is generated and all the loan docs, the entire payload is all assembled and pulled together, and it is handed off into the rails, the digital interconnects that LoanStar provides. So we're integrated into LoanStar, and then LoanStar shepherds this loan digitally right into the actual LOSs that are deployed within a given credit union. On the front side of this, as we were looking at the address information, we're also cross-checking the address information against LID, LMI, CDFI APIs and data sets that CUCollaborate maintains, so that we can also determine whether or not this is an LID borrower and whether or not specific special actions should be taken during this workflow based upon that designation. So, so we're really kind of in the middle here. On the front side, there's data acquisition that we're doing behind the scenes with CUCollaborate, and on the back side, there's data transfer that we're doing with LoanStar. And ahead of all of that, the way that a consumer, a borrower, even arrived at this portal at the start of this whole process would have been through LoanStar in many situations, because LoanStar has also onboarded merchants onto their platform, and so it's that source that brings a consumer into this journey. Sorry, Abheek, I just wanted to make sure that we clarified some of that.
So all of this is coming together. And then I think one last piece was the additional information that we push that we would be pushing into the credit union or into the LOS is all the information that we've collected, the decision that has been taken by this engine, all of that is packaged into this report. This is an underwriting report that we generate that talks about the offer information. It talks about all the underwriting checks, whether they approve, which of these checks were passed, which were failed. I think Sid talked about this earlier, that what we implement in the back end of the engine is bank-specific or credit union-specific underwriting checks. So whatever is your custom underwriting check or specific underwriting check, that is implemented behind the scenes, so that when we approve somebody through a loan, the likelihood that he would get a different decision when the underwriting is performed by the bank is close to zero. And then, as you can see, we also collect the AVM report. So the AVM report on the property is captured. The tri-merge credit report is captured. So all the information that we've collected and the decision that is taken is all neatly pre-packaged, and everything is pushed into the LOS. The idea here is, the objective here is twofold. One, whatever decision is taken by this engine, we want to minimize the chance that this decision is reversed by the underwriting that happens inside the bank. And that's one of the reasons why all the underwriting checks and the rate cards that are actually being used by the bank or the credit union is being implemented in the engine. And the second thing is, we want to take all of this information and push it into the LOS, so that the amount of time needed to close the loan is very little. And we want to make sure that the loan can be originated as quickly as possible, and therefore all of this information is packaged so that the amount of work that the loan officer has to do is minimized. So I think that's the end-to-end workflow here. So I'll pause there as well.
Awesome. Thank you, Abheek. Ben, I think at this point we probably have thrown a lot of information at the audience. Should we just pause here and open the floor to questions before we continue with the rest of the presentation?
Yeah, I think that'd be good. As I mentioned earlier, please do feel free to submit your questions via the chat function and or the Q&A section of the webinar here today. Don't have anything coming through those channels quite yet, Sid.
Okay.
But I think as you're covering how you're envisioning this to work with the consumers, can you tell us a little bit more about kind of like the uptake? I'm sure you guys are probably going to present on this as well. Up the lift for a credit union to start working with you guys. What does that look like logistically?
Yeah, you know, the lift is so far from the work that we've done with credit unions and with community banks, the lift has been very trivial on our side because we're working so closely with you and so closely with LoanStar, and that we have these pre-integrated rails, and LoanStar in turn has done extensive integration with various LOSs. By and large, we're able to get deployed within a credit union within a span of a few weeks, essentially sharing the credit union, sharing their underwriting guidelines and sharing their rate card, their rate sheets. Those are all getting codified into our underwriting engine, coming to an agreement with the credit union about how sensitive they'd like for us to be when we do that additional risk optimization, where we're fine-tuning the size of the loan. Even after it fits within your credit box, we're still fine-tuning the size of the loan to really kind of dial in on that risk to keep it safe and responsible. Just coming to an agreement on how sensitive the credit union would like for us to be on that, so that we can then go ahead and wrap the insurance. All of that can really be done in anywhere from 1 to 4 weeks. It hasn't really gone much longer than that. And there isn't much that we're asking the credit union or the CDFI to do here. There's no IT involvement because all of this is happening in the cloud. And so it's a cloud-based platform. So very minimal IT involvement. Of course, there's going to be security involvement. There'll be due diligence that the credit union is going to want to do. And there'll be due diligence paperwork that they'll ask us to complete. But we tend to complete that very fast. We are SOC 2 audited and compliant. And so all of our own information security audits and reports are easily made available to the credit union.
We do actually have a question coming through the chat for you, Sid. So through your platform here, are loans delayed or referred if the applicant is either like unwilling or unable to link their bank accounts for income verification, or how does that work?
And this is what really separates us from fintechs, because normally like a Figure or Spring EQ, they'll just essentially kick that individual out of the workflow. What we essentially say is no, if this is something that you're unwilling to do, or something got gummed up in the process and you've not been able to attach your bank statements, or you have not been able to do this, then what we do is we still route that incomplete Form 1003. We'll still route that to LoanStar for delivery into the LOS so that a loan officer can reach out to this individual. We will at this point have collected enough information, namely their phone number, contact info, address, name, first name, last name, whether or not there's any co-borrower. All of that information is still very rich and valuable information, and we will pass that information off to the credit union so that a loan officer can then kind of reach out with that human hand and complete the rest of the journey.
I don't have any other questions or comments coming through the chat or Q&A section quite yet. So if you guys want to pull the rest of your presentation up and continue on, I'm sure that we'll get some more participation here as you proceed.
Yep. Let me do that. Let me go ahead and pull up. Okay. So one thing that we glossed over that is important is just making sure that we ourselves are well attuned to just how large the untapped ESF market is. Geoff cited some of the existing numbers around embedded financing. That's embedded financing that is unsecured, which is creeping up into the larger loan size brackets. And these are fintechs, again, taking market share and disintermediating members. And we feel that there's a really large untapped market here once we start thinking about secured lending. So there's over 20 million LMI and LID homeowners, substantial home equity. When we multiply that untapped home equity, median home equity by the number of LMI and LID homeowners across the US, or I should say across the lower 48, we're looking at close to $3 trillion of untapped equity. And the typical FICO, when I say typical FICO, I should mean that the vast majority of FICO scores across this cohort is higher than 680. I think the median FICO is somewhere in the neighborhood of 723, but that number might be changing. And so, so there's a lot of real high credit quality untapped equity that can be unlocked here to help homeowners meet the needs of financing that they have from mid-size to large-size transactions that are hitting them on a daily basis. The areas where it does become risky or tough are the things that we really wanted to protect. When we look at, I'll draw your attention to the bottom graph. When we look at data going all the way back to the 2000s, early 2000s, what we see is a really tight pattern of HELOC delinquency rates following the quarterly unemployment rate. Unemployment has been the real root cause. More than 98.7% of delinquencies boil down to unemployment or to a lesser extent, medical disability. So that's what we really wanted to cover and provide peace of mind for. The other thing that we wanted to really provide peace of mind and convenience for is that the LMI cohort, LMI and LID population, compared to 2000 versus 2020, the blue graph, the blue chart, the blue curve on the upper chart versus the orange curve, all that's really saying is 20 years ago, 25 years ago, LMI and LID borrowers and homeowners, they had a lot of similarity. Their incomes, their debts, their liabilities, their DTIs, they all really kind of cloistered within a tight, narrow band. And what we're finding now, 20 years later, is that there's been enormous diversification. And so manually underwriting against all of this diversity becomes labor intensive. And so this is where the convenience of technology was really paramount. And it's really being able to address and serve this really diverse population that was a huge driving factor for us as we innovated and developed this technology. We will send out the slides. What we really wanted to do here is just demonstrate that once you start thinking about secured finance and embedded secure finance, it really opens the imagination to all sorts of different ways in which this embedded secured finance could well be embedded into a variety of different transactions. So for instance, some credit unions that are emerging with products in California are looking at the explosive growth of the accessory dwelling unit space in California. And this is happening across multiple other states. And there are some unique challenges to underwriting HELOCs that would be used for ADUs. And the ability to adapt the financing that you do and the underwriting and the pricing that you do to be able to adapt it to serve the nuanced needs of a particular type of transaction, which might be an ADU transaction. That's all made possible through this whole technology stack in a really fast way to be able to configure and roll out a new type of credit product that is at its core a HELOC, but might have certain bells and whistles to it that make it especially distinctive for serving a particular market. That now becomes a rather easy peasy process because of the real deep configurability of the technology that's underneath the whole capability. So I would actually end right here because the rest of our conversation here really delves more into just how do you configure ESF to satisfy the needs of a variety of different types of transactions like ADUs or elective medical procedures, et cetera, and we could get very deep into the nuances of all of that. But insofar as really laying out the high-level key points of what is embedded secured finance and how easy is it for a credit union to bring it to its members, to bring it to the small and medium-sized businesses that are already within that community. The high-level overview that we provided here essentially lays out all the key touch points that are essential to making this something that as a credit union or CDFI you adopt and bring to your communities.
Thank you, Sid. I know one of the biggest questions that we get from our clients is, tell us about how this works at like a credit union level. Like, I know you guys are working with a couple credit unions, as well as I know LoanStar works with several credit unions across the country. Give us like an example of how this might work, like at an actual, how are credit unions like leveraging this to help them achieve their strategic initiatives?
Thank you. That's a great question, and I think the easiest way to really lay that out would be that since the journey begins with LoanStar, I would defer to Geoff. If you can get that dialogue going from the LoanStar side, then we could complete the picture from the GreenLyne side.
Yeah, so I'll just add that, a couple different ways to think about this could be, I alluded to it earlier, but maybe you have business members today that maybe they could use this type of service to finance their customers. And that's really some low-hanging fruit at a lot of credit unions. And more often than not, I think I was reading a McKinsey report that said small businesses are highly likely to change their primary financial provider in a year-over-year scenario. So a way that we try to help build your moat and make and protect you would be, let's offer those businesses that may have some significant deposits with the functionality that Sid laid out, where you can now offer financing at the point of sale for their businesses. And we tend to focus on home improvement a lot because that's, just sort of is what we do a lot of. But I think you could think outside of that as well. The example of the IFV, there could be many different use cases. And what I love about what we're doing is it can be very bespoke to your specific geographic area and field of membership. So that's one way to really think about it kicking it off. From a technology standpoint, Sid, I'll just mention like the integration work has been done with LoanStar and most of the HELOC LOS providers. So really all that's involved there would be sort of an addendum between you and your LOS provider to allow for this integration to take place. And then a lot of the work is done sort of behind the scenes between LoanStar and that provider. So Sid, I don't know if that helped kick things off, but I think there's just a massive opportunity to help local communities where we can really help do local lending with local, for local companies in specific areas that may have been underserved in the past.
Yeah, I mean, that does help because once LoanStar has been deployed to a merchant, that merchant is having a conversation, like to just walk through a use case here. That merchant is having a conversation. Let's say it is a roofing contractor having a conversation with a homeowner. And that homeowner, let's say, is also already a member of a particular credit union that LoanStar has become embedded with. So the way that this would work is that that merchant is having that conversation with that homeowner and is quoting a $22,000 roof replacement. The merchant would immediately log on to the LoanStar system, which is called Merchant Link, and would specify through Merchant Link that this is the homeowner that a quotation has been generated for. This is the address, and it's a $22,000 project. In that moment, in that instant, Merchant Link is passing that information directly over to GreenLyne. And what Merchant Link is also doing is it's generating an email to that consumer, to that homeowner, giving the homeowner a URL that they can click through to arrive on to that portal that Abheek demonstrated a few minutes ago. And all of their information is already going to be populated there. The project size, the address, their name, all of that, so they don't have to fill that out. And if they want to then type in their gross income, which we don't have until they type that in, they can do so and then hit generate offer, and they see the initial offer. If that initial offer cannot be generated because from all the soft credit pulls and AVM pull that we did, we see there's not enough CLTV, or there isn't sufficient DTI or sufficient FICO that allows them to fit within that credit union's credit box. We don't make an initial offer per se, but we do invite that particular user to contact a loan officer, or a loan officer will contact them. So Ben, that's the end-to-end journey of what this looks like from start to finish.
I know that we're going to get other questions directly from credit unions. Typically what happens is I'll get comments or questions via email after our sessions. But if you could, both Sid and Geoff, you could drop your contact information in the chat if anyone needs to reach out. That would be great. And then for everyone on the call here, we will be providing direct contact information and an opportunity to meet to discuss further. If you have other questions, don't hesitate to reach out. Looks like, okay, great. Looks like we do have another question coming through the chat here. Oh yeah, this is great. All right, so could you explain in a little bit more detail how we would increase penetration and volume of CDFI and low income designated qualified borrowers? And there's some additional question here. Also, what merchant guarantees are there with, with satisfaction of the work completed to protect the member and reputation of the credit union, i.e. if there are complaints, do we at the credit union have to be intermediary to resolve those issues, or who resolves those issues? So I think first and foremost, explain a little bit about increasing penetration and volume with CDFI and low income designated. I can also jump in there too, but.
Yeah, maybe I'll take a first stab at it. The way to do that, because of CUCollaborate, we have a lot more insight as to where these areas are, as laid out by the NCUA. So we use that functionality there. So the best way to do it, Elizabeth, would be to identify merchants that serve that area, and then we focus in on those specific merchants to begin with that are going to likely be within those qualified areas to offer this. So that's number one. A way that we look at your second question about the merchant guarantees, a lot of times before funding would take place, we have like a work completion form, so that at some point before funding would occur, that contractor would need to have a sign off basically from that borrower saying that the work's been completed to their satisfaction. So that eliminates any sort of messiness between that. But Sid, I don't know if you have anything to add to that or if that aligns with what your thoughts were.
Yeah, Elizabeth, thank you for this question. Just piggybacking on what you said there, Geoff. So two things. One is that in terms of LID, CDFI penetration, in addition to identifying merchants that are within the census tracts that can serve homeowners that are within these areas, it's really important to be able to provide a secured loan facility that can be a small-sized facility. So by taking out a lot of the labor and a lot of the cost and de-risking these loans, what that makes possible is the ability to originate a loan that can be as low as $20,000, $25,000. And so that is quite often the size of loan that's needed by an LID or an LMI homeowner for roofing repair, for HVAC repair. These are projects that otherwise would have gone to 3 credit cards, split across 3 credit cards, put on a personal loan from Upstart, or a combination of 3 cards and a personal loan that can now all be brought into the single purview of a HELOC. So that's one additional point that I would make on top of what Geoff mentioned. And the other point that I would make is that the loans are not, or at least the HELOCs that we envision originating here, the funds are not being dispersed to the merchant. The funds are being dispersed to the homeowner. And so the homeowner has the final decision and authority about whether or not they want to move those funds over to the merchant. If they're unhappy with the merchant's work, then those funds can be held onto by the homeowner. And so we feel we have always felt that was very important, and it's something that distinguishes this from construction loans, where with construction loans, oftentimes disbursements are being made to the contractor, but here it's always the homeowner being in the driver's seat.
All right. Well, thank you guys so much, and thank you guys for the questions. I really appreciate the participation here, and for everyone's time. A few last reminders. One, recording and all the materials will be sent out via email in a follow-up communication sent out tomorrow. And then 2, don't hesitate to reach out with any additional questions. Please utilize, Geoff and Sid both dropped their contact information in the chat. You may reach out to me at any point as well. So thanks everyone for your time. Thank you, Geoff and Sid, for joining us today.
Thank you.
Thanks, everyone.
Thank you, everyone. All right, bye-bye.
Bye.